This conference will now be recorded.
So, good morning, good afternoon, everyone, and welcome to a fresh new session on IFRS9 Impairment Model Development Validation. And in the last class, we were talking about the impact of macroeconomic variables, right? So, so we will continue our discussion from there. But before that, let's just kind of create some kind of a perspective. So last class we could not proceed much because there was not much of an audience. It was only Pradeep and myself. But so what we'll do is we'll try to bucket up today in. So we'll try to bucket up in today's discussion, right? So over here in the last classes, the last couple of classes, we started talking about the macroeconomic variables, right, and their impact in IFRS9 measurements. So what we started doing off from the last class was we looked into the key macroeconomic. We started looking at key some macroeconomic variables which need to be there for IFRS9 for making for converting the point in time PD to forward-looking point in time PD, right? So this macroeconomic adjustment is a very crucial adjustment for probability of default models and in probability of default models which are built under IFRS9. So over here we started talking about some of the very key macroeconomic variables. Two most important or widely used macroeconomic variables were number one, the gross domestic product. So we talked about the challenges and advantages of using gross domestic product as an economic variable for modeling the IFRS 9 impairments. Now, from there, we went to talk about the real GDP, that is adjusting the GDP to the price levels, because an increase in the price level, given the level of output, can also result in an increased GDP. But now, if you are adjusting it for the price level, then what happens is that the only increase rate and record is because of the increase in the productive capacity of the economy. Now, again, from there, what we saw was that GDP gave you an overall idea of the overall economic activity, right? But again, within in today's world, in today's integrated economies, domestic resources and foreign resources work within a geographical boundary of a nation, right? So, like in a country like US, you have people from all over the world going in and working who earn their income, and those income do not find a place in the national income accounts of that particular country. So many of them are repatriated back to the home country of these foreign workers. So therefore, there is an impact of a net financial transfers from abroad, right? So if this net transfer is a positive value, the GNP is generally higher than the GDP. If not, GNP can be lower. So GNP, or the gross national product, shows the exact amount of income that has been generated within the domestic boundaries of the nation, right? So the next question that comes out over here is that if I'm talking about GDP, I'm talking about GNP. Now, and I've been talking about price levels, I've been talking real GDP and so on. So the next question that comes out that we can see is that in an economy, all these economic macroeconomic variables are they are kind of joined with each other, right? So variable x1 related to variable x2, so GDP related to price levels related to NNP, to the GDP. Then both these two are related to the unemployment rate. So it's in a it's a kind of a framework where all these things are interrelated with each other. So it's in a general equilibrium framework as we call it, right? So one thing is that when your economy is undergoing a phase where your aggregate demand is expanding, so the output in the economy expands, followed by and increasing the price levels. So basically, what we want to understand over here is that when the real GDP in the economy goes up, it implies that the productive capacity of the economy has increased much more than it has increased relative compared to the increase in the price level. So this is one of the parts that we had been talking about on that side. Now the next thing that we need to that we would be seriously talking about over here would be the fact that the GDP. So the next thing that we started talking about over here was we started bringing in the role of interest rate in the last class, right? So what we started doing was we started talking about uh, we started talking about the interest rate. We started talking about how an increase in the interest rate or an impact in the interest rate would cause the macroeconomic variables to react, and how would that, and how would the increase in the interest rate pass through the different macroeconomic variables and would impact the default rates in the bank, right? So over here, one thing that we started talking about was we started depicting a macroeconomic framework for an economy. So we talked about the aggregate demand equal to the aggregate supply framework, where we brought in three major components of an aggregate demand. That's the consumption, expenditure in an economy, the investments, and the government expenditure. So now we consider that the government expenditure is something exogenous, and what we do is we focus on the income and the the rate of interest. So we focus on the income and the rate of interest, or the relationship between the income in an economy and the rate of interest in the economy. So this is something that we try to kind of focus on, right? So over here, if you see or if you think about this, right? So what we would try to do over here is we would try to understand the impacts of an increase in the lending rate. So basically, if the increase in the lending rates happen, right, if the lending rates go up in an economy, right, so obviously what happens is the supply of funds increase, right, and the supply of the funds generally tend to increase, and the investments in the economy tend to go up. I mean the investment in the economy tend to go down. So therefore, the demand in the economy, demand for credit in the economy goes down, and the supply of funds in the economy generally increases. The logic is very simple. So if you see that the savings rate in the economy has gone up, then what you do is you see that the rate of interest in the economy has gone up. Then what you see is, okay, so what we do over here is we do not look into. So basically, what we are trying to do over here is we are trying to look into the rate of so the increase in the rate of. So we're trying to assess the impact of an increase the rate of interest, right? And how would it go ahead could be impact the defaults in the banks. So how is an increase in the rate of interest related to the default rates? So let's say the rate of interest has increased, right? So when the rate of interest has increased, the savings of people would be willing to put more and more funds into the bank. The bank would be flooded with funds, but the demand for credit would have gone down, right? So now the demand for credit is relatively lower. So now, how does the scenario look like? Now, what happens is the bank has more amount of funds with them, but the funds cannot be lent out, right? Because the rate of interest has gone up. Now, because the investments in the economy go down in the subsequent stages, the overall income or the GDP in the economy would also start going down. Now, when that happens, when that GDP in the economy starts going down, the next stage is that would cause unemployment to increase, the income to fall, and finally, when the income starts falling, what people would do is the amount of money that they kept back in the bank, they would start putting it down from the banks, right? So finally, what you see is that an increase or increase in the rate of interest or subsequent increases in the rate of interest would cause and a reduction in the would cause a reduction in the uh, overall investments and the productive capacity of the economy, thereby adversely impact the disposable, they adversely impact the unemployment, right? And that increase in the unemployment would cause the overall disposable income in the economy to go down. The for overall affordability in the funds would go down, and the bank's portfolio would start becoming more and more riskier, right? So with an increase in the interest rate, so economy which maintains very high rates of interest often attract or faces two challenges. One is it might enter into a downturn, right, which would cause lending to become more stringent, right? And on the other hand, at very high rates of interest, you often tend to attract bad borrowers, because borrowers who are good borrowers or who do not want to default on loans would move out from there, right? Move out from that cycle. And borrowers who are indifferent between paying back and defaulting are the ones who would go ahead and take go for the credit at that high rate of interest, and hence you are attracting an adverse set of borrowers, and hence you have ended up creating an adverse selection problem, right? So with this function, the default rates in the banks are likely to increase more. So with a higher rate of interest, the higher cost of borrowing imposed in the economy for a substantially long period of time, right, the overall riskiness in the banking system tend to increase, because it is most likely that it would attract more and more bad borrowers than good borrowers, and hence over a certain period of time the number of defaults or the overall defaults in the bank would gradually increase, right? So this is one of the framework that we generally get to see. And you know what, with every increase in the rate of interest, the amount of investments actually go down, because investments rate of interest is nothing but it's the cost of borrowing funds, which is again invested into the economy for productive purposes, right? So this is the framework that we had discussed in the last class. So one thing that we can clearly see from here is, right, that what is that impact that you would have if the rate of interest in your economy went out. So how is it that an increase in the investments or an increase in any component of the consumption expenditure, autonomous expenditure government, how is it that it would impact the rate of interest, or how is it that it would impact the output in the economy? So that is something that we need to explore over here, right? So is this chain of events clear to you, the one that I discussed right now? So one thing we can clearly see is an increase in the rate of interest for economy maintaining high interest rates for a substantial long period of time can lead to an increased riskiness, and that might make the lending portfolio of the bank relatively more riskier, right? Because with continuously high rates of interest, investments would plunge, and thereby the output in the economy would plunge, and finally that would end up in a downturn period where the banks would become even more conservative. So this is where the risks actually come, and this is how the rate of interest is related to the downturn, right? And that is the reason, specifically why banks today do not charge a unique rate of interest to everyone. They do a risk-based lending. And that is the advantage of risk-based lending. It helps you kind of balance between the less risky and the more risky borrowers, right? Right? Okay, so is this explanation clear to us? Okay. So next we'll try to look into that. How is it that this impact is, felt in the output, and all this relationship that I've been talking about. How do we get to see these impacts in the real world? So I'll explain that, and that will help us again better explain as to how portfolio. Why is the portfolio, or why is it that the macroeconomic adjustment is important to make the portfolio forward looking? I mean the PDSMS forward looking point in time. So we'll gradually move ahead and talk about the PD and that relationship, right? So just give me a minute, go through this framework or this graph that I had drawn, and then I'll just get started. Give me a minute. Okay, so let's kind of start talking about this part. Okay, so generally, when we are trying to explain an economic behavior, or when we are trying to explain a macroeconomic behavior, we try to assess it at something called an equilibrium. A concept of an equilibrium is very simple, and it's a very well-known concept in economics where you say that the demand equals supply. So it's a price, or it's a part where at which the market clears, right? So there is no excess supply or excess demand left back. Aggregate supply equals to aggregate demand. So over here, the aggregate supply in the economy is nothing but the output, right? The amount of output that you can that the economy, the output that is produced. Now over here, this output, or this income which is generated, is divided into three broad heads of consumption. So a part of the income, national income, is generated for consumption expenditure, like retail expenditure, buying refrigerators, food items, cars, automobile, cars, watches, etc. Right. The second part is the investment function, which is or the investment field, which is used by the the entrepreneurs, right? So they borrow loan, they invest it into, so out of the part of this income is invested into the economy, right? So basically part of this income is kept into banks as savings, and from the savings, from those funds, the investment expenditures are financed. And another part of it is the government expenditure, so where we have the G. So over here we say that the consumption expenditure is proportional to the income, right? So the next part is, the investment, right? So in the investments, what you can see is that I bar is the autonomous investment which is done, right? So these are the investments. This is a part which we theoretically talk about from an economics perspective, from the perspective of an economics, right? And the next part that I have over here is, and the government expenditure is something which is exogenous because we don't want to determine out of government expenditure. We know that it cannot be determined in the market models. The government takes its own set of decisions, right? So over here, you will see that there is an autonomous component. So every economy, right, no matter what, there's always an autonomous component which is there, right? It's difficult to identify that autonomous component. So you can say, you can think of an autonomous component, if I'm thinking about in real data terms, you can think about it as a long-term expenditure, right? Or you can think about it as a long-term average expenditure that generally happens irrespective of whatever the income in the economy is or not. So this is one of the parts. So then what I have over here is B into Y. So the figures or the symbols over here is not very really important for us. So what is important for us is to understand the relationship between the rate of interest and the, you know, the rate of interest and the output, right? So that's what we all want to understand. So this is A. So we'll call this A. So this A is nothing but A plus I bar plus G bar minus CR, right? So what we'll say over here is it is something like this. So if I do some kind of a subtraction, the other side is 1 minus B is equal to A minus CR dot R. So this says that Y is negatively related to the rate of interest. So if you have a look into this mathematical equation that I have written, of this simple algebraic equation, so you need not bother about the interpretation of each of these components because since we are not talking about economic models per se, so let's not talk about this, but just let's look into the relationship that each of these variables that exists between each of these variables. So it is C by 1 minus B. So this is the slope coefficient. If you see, you will see this is in the form of an A minus Y equal to mx plus C. Right? So one thing you can clearly see is that if Y increases, I mean, if the rate of interest increases, the Y in the economy decreases, right? Because as our rate of interest increases, the investment goes down. Therefore, the overall output in the economy will also go down, right? So just let me plot. So this result essentially curves or it stems from the investment savings graph that we have described over here, right? And hence this relationship is known as, or I will call this in the jargon of economics or in the economic literature as the IS curve, or it is the investment savings curve. which shows the relationship between output and the rate of interest in the economy. This is what the IS curve is, right? So one thing that you will see is that in the product market, and every increase in the rate of interest will cause the output in the economy to go down. So now, if I plot a graph, so over here what we have is the rate of interest, and over here we'll have y. Right. So over here, right. So one thing you can clearly see is that the output and the rate of interest is negatively related in the product market, and this relationship, as we call it, is called the IS curve. So any point on the IS curve is a function of the rate of interest, and given the rate of interest, it will tell me that for the economy to be in equilibrium, what should be the corresponding output, right? Right. So if the rate of interest increases, the more the rate of interest increases, the lower is the output in the economy from the product market. The next thing that we get to see over here is the following. Okay, right. So over here, so is this concept of the IS curve clear? So the IS curve that I have been talking about. So this is one of the major relationships. Now you can think about it that assuming that I have a product market in the economy, every time my rate of interest increases, my output would start going down, right? And if I maintain a high rate of interest over a substantial period of time, my output would continuously keep on going down, right? And hence I would enter into a downturn. And if Y goes down, So then in the real time, what will happen is my YD, or my disposable income, will also go down, and that would in turn have a relationship on, or have an impact on the default rate. So if the R goes up, right, and Y goes down, then but with every lower rate of interest, your default rates will also increase, right? And hence, in such a situation, you will expect that, so with every increase in the, with every tightening policy, right, your economy goes nearer to a downturn and a higher impact on the default rate. And this is the reason why, this to make the IFRS 9 more PD forward looking, this relationship has been shown, right? So that's one part. The next part that we have over here is on the money market side. So every economy, so if I talk only of the product market, it is the product market, right? But again, when you are trying to look into the product market side, and when you're looking over here, you're looking from the demand side of things, right? Now again, there is a supply side to the story as well. So imagine when the rate of interest go up, people will start putting or holding back lower amount of money, and they will start giving out or putting out higher amount of money into the banks and the financial institutions, right? So the supply of money will therefore increase, right? So now, so if you think about it, the liquidity is that the bank would have more and more amount of liquidity with them. So therefore I need to also look into the money market fund as well, and to look into the money market and how is it that the individual or the household sector would behave in the money market. So therefore I bring in the next concept over here, which is the concept of the money market. Now when I talk about the money market side, so what am I actually talking about? So I'm talking about the money. So what is money? Money is the amount. It's a so the amount of cash or the amount of money that you have with you for meeting your day-to-day needs. Now, money. Whenever I talk about money, even if you think about the money that you have with you, right? So you at the end of the month you get a salary, right? So that salary is your income, and it comes in form of a monetary denomination. Now, with this money which comes into us at the end of each month, we have two types of demands with that money. So, what is the first demand? First is the transaction demand for money. So, what is a transaction demand for money? So, when I get the money, I go to a stop, or I go to a retail store, I go to a restaurant, and I use that money. So, that is called the transaction demand for money. So, when I talk about the transaction demand, what I essentially mean is I am trying to talk about the amount of money or the demand for money that I have for to run my day-to-day transactions, right? And the second set of demand that we generally have is the the speculative demand for money, right? Now, when we talk about the transaction demand for money, so what is this transaction demand for money? Now, in transaction demand, so this is the amount of money that we require to carry out our day-to-day transactions, right? That we need for survival. So we use this money to carry out day-to-day survival for our day-to-day needs. So therefore, this transaction demand for money is this transaction demand for money is generally positively related to our income. So the higher the income in the economy is, the higher the transaction demand is. Right? So over here, what we have is, so I'll call this money demand or demand for money with a prefix of T. And this is where you say that you have a positive transaction demand. So if I have some kind of and if my income is zero, but still I'll have some kind of a demand, so which is, I'll say, as alpha 0. Alpha 0 is equal to alpha dot y. We have over here is the speculative demand. Now, how do you think will or what are the factors on which the speculative demand of the money would increase? I mean, would depend on, and what are the certain rates of interests, and what are the relationship that it would have with uh, with the income, and how is it that this would what are the factors on which it would depend? So speculative demand for money is dependent on the rate of interest. So if you have this R, let's say beta 1, which is the rate of interest, right, with R, right? So what happens over here is that when this money demand, when the transaction money demand is there, and the transaction and the speculative demand for money is there, when I add the two up, what I'll get is I will get the total demand for money, right? The total demand in the money. And when this rate of and when the rate of interest is higher, this money supply or this demand for money actually goes up. So what we have over here is we have a positive relationship with the rate of interest, right? So now the total money supply will be equal to the total money demand, assuming that the money market has to be in equilibrium. So what we'll say is the money supply MS will be equal to the money demand. So now obviously observe that it is the rate of interest which is driving the entire part of money demand, the speculative demand for money, as well as it is driving the product market, because the investments which are happening in the product market is being financed by the financial sector. And this is why the variables which link the monetary, which links the financial sector and the product sector, the final money markets and the product markets, is so crucial for the banking domain, right? Therefore, this is the reason as to why interest rates or fluctuations in interest rates create huge losses to banks, right? And the reason behind it is this interrelation between the two, right? So let's say that the money supply is for us over here is M bar, right? And there is an autonomous demand for money comprising of transaction demand, which is alpha 0, 0 plus beta 0. Let's call it delta 0 plus you have alpha 1 y and beta 1 r. Right. So over here, so what we see is the money supply in the economy. So if I have a look into this, I can say that the money supply is equal to delta 0 plus alpha 1 y. Right. Now, obviously, there is another relationship that this money supply that is generated, assuming that the entire output is being generated in terms of monetary output. Therefore, the output that you are generating should be equal to the amount of money that is there. So therefore, at the end of the day, so when you are into equilibrium, this m bar should equal y, right? So now, if you have a look into this, I can tell you that this y is now positively related to r because it is delta 0 by 1 minus r plus beta 1 by 1 minus alpha 1 into r. So in the money market, the R and the Y are positively related. The relationship is very simple because the higher the rate of interest, the more amount of funds people are willing to keep in the market, and hence greater the funds that these borrowers have, and hence the output will increase, assuming that the demand remains. So assuming that there is demand for the funds at the higher rate of interest, right? So this is a curve, or this relationship is obtained from the liquidity of money, and therefore this is known as the LM curve, the liquidity of money curve. So now over here in this money market, if I kind of plot this relationship between the rate of interest and the output, you'll see is the following. So if you just come to here, y rate this output. output, right? So this is something that we now we'll have a look into it, and the graph that I have over here is something which looks like this. So this is called your LM graph, which is again a rate of, which is again a kind of a function of the rate of interest. So over here, what we have is a lower rate of interest, the output will be lower, and as the rate of interest increases, the output will be higher. So over here, we can see that in these two sectors of the economy, we have two different relationships operating. And now, if I want to find out that what should be the equilibrium rate of interest and the output in an economy, I should take up the following. So over here, if we have a look into the graphical frameworks, right? So over here, what we have is rate of interest. And over here, what we have is output. So now let's have a look into this graph. So how does this graph actually work out? So this is the IS curve that I have, and this is the LM curve that we talked about. So the point where it intersects gives us the rate of interest, and over here it gives us the output, right? And this is the point of equilibrium. Now let's say the economy expands, right? Now what will happen if the economy expands? So given everything remaining unchanged, the demand for goods and services will go up, right? And there will be an expansion on the right hand side of this equation, and then this curve will actually shift out. Now from the economy's perspective, right? So what will happen? The rate of the moment this happens, right? The rate of interest in the economy will go up, right? Rate of interest in the economy goes up, goes up. Let's say R1, right? So over here, the output in the economy also goes up. Now, why is this going up? Because the curve had shifted, IS curve had shifted outward, implying that there is an increase in the demand for the goods, right? And hence the rate of, and hence there's an excess demand for funds, and hence the rate of interest has increased. Because there was an excess demand for funds, the rate of interest has increased, And now with an increased rate of interest, what happens is people are trying to save more and more into the economy, and hence the overall economy is expanding. So over here, you see that the increase in the rate of interest is not being brought from outside. The rate of interest is increasing as a result of an exogenous increase in the aggregate demand. So when your aggregate demand in the economy or the demand in the economy is high, right, the rate of interest or the lending rates would be relatively higher, because when the rate of interest are higher, the banks are also giving a relatively higher rate of interest to the depositors, and from that what we can see is that yes, this borrower is working, and hence from there we can see that yes, this output is higher, the economy has expanded, and given the economy has expanded, uh, everything is growing, right? The output is growing. Now, in such a case, when the rate of interest increases as a result of the excess demand for funds, then then it has a very favorable impact on the default rates. So in that case, the default rates do not generally increase, because you know that this increase in the rate of interest has been brought about by an increase in the demand, the aggregate demand in the economy, right? And therefore, you can say that yes, this economy is now expanding, and hence the funds, and hence there is a demand for investment demand. On the other hand, there is also a expansion in the output, right? So this is how, when these two markets come in, their impact on the banking sector can be felt. Now, on the other hand, let's say the rate of interest increases. So when the rate of interest in an economy increases, what happens is there is a movement along the supply curve. I mean, along the IS curve, right? So let's say the Reserve Bank of India or central bank increases the rate of interest from there to here along the IS curve. So what happens the moment this rate of interest increases, because the aggregate demand and the supply all were as they were, and suddenly the sudden upward pressure on the interest rate is felt. Now, when this upward pressure is felt, right, the people who are trying to who are borrow funds, some of them move out of this borrowing cycle, right? Hence, what happens is now the LM now when the increase the rate of interest, more and more people want to keep money with the banks, and hence the LM curve or the liquidity for money curve shifts outside, right? And hence, what you see is that the output in the economy falls. So the rate of interest when the rate of interest is increased exogenously, therefore government central banks, when they are trying to take decisions, right, on regarding the interest rate movements and interest rate policies, they're framing monetary policies, they need to always keep in mind this particular trade-off. So any policy which expands the aggregate demand, which gives a boost to an aggregate demand, and thereby brings out an increase in the rate of interest, is because there was an excess demand, and that excess demand pulled up the cost of borrowing. So that does not so that impact gradually moves on to the money market, right? And people start giving more and more money into the banks, and banks have more funds to be paid out, and hence the on the whole economy expands. But on the, let's say an economy is at a given state, and the bank central bank wants to curb that excess aggregate demand. Hence, what they do is they increase the rate of interest. In that case, the moment and rate of interest increase happens, there's a movement along the IS curve, and the output in the economy falls. So it's very important to understand the impact from which is what is the source from where the interest rate is being impacted, because the source from where this impact is coming in is the one which would determine whether that macroeconomic variable, the movement in this particular macroeconomic variable, would lead the economy to expand, or it would lead the economy to contract, right? So this is precisely the overall idea that we have, right? So just go through this framework, see if there are questions. I'll take those questions up, and then we'll move forward. Just take 2 to 3 minutes time, look into this, get this thing into your minds. Because over here, from here, the next idea would be to pull it into the model. Yeah. So any queries up to this point? Yeah. So any questions up to this point? Okay, great. So, so let's try to look into some other nuances in more detail, and let's try to link it back, right, to the profession that we are in. So this was all a good. This is a very famous, theory. It's a extension of the Keynesian theory in economics, which talks about it's the ISLM framework, right? It's famously known as the ISLM model framework, and it's very interesting to see this framework. And it's a very simple framework, yet it helps us explain different characteristics uh, of the interlinkages that can be observed in the economy, right? So this is something that we have. Now comes the next part. So this is all good theory and discussion. Now let's say, how do you think can we relate it back to our domain, right? So you are saying that I'm saying that when the aggregate demand in the economy increases, right, the rate of interest increases, the output expands, and the rate of interest increases because of the excess demand, and hence you have the and hence that the output increases, and hence disposable income increases, the default rates go down because when the economy is expanding. Now the question that comes out to me is that should I incorporate GDP, price level, and interest rate in the same model? So now I now need to start thinking about how can I implement this framework in the model, right? Because what you see over here actually happening is that higher the rate of interest, so in the economy, higher is the default rate, right? But that is when the economy, when there's a movement along the demand curve. So if there's a movement along the, and if there's a shift of the IS curve, in such a case, this challenge does not really hold. So let's try to explore this and let's try to think about it in modeling terms. So what I have done over here is I have actually incorporated output, which is GDP. I have incorporated the price level, which is the CPI, or the price level of the economy, and the third is the rate of interest. So these are the three variables that I have brought into consideration for discussing the impact of, or for trying to understand how is it that these three variables can impact PD measures, the next 12 months point in time PD measure. So from here, what we'll try to do is we'll try to move across, we'll try to move ahead with this. So let's think about these three variables first. Let's say I'm incorporating the GDP. I'm not going to the GNP first, I'm talking about the GDP, right, which is the measure of output. Then I'm incorporating CPI, which is a measure of the price levels. And what we are doing is we are incorporating GDP, CPI, and uh, the interest rates. Interest rates, right? So now these are the variables which will enter into predict the actual default rate. So basically I have a PD estimate and to them I will be incorporating these variables. Now let's try and understand that when I'm trying to develop a point in time PD with macroeconomic variables, what exactly is the challenge that I am going to face. So that is what we next need to talk about. So what do you think? What are the challenges? So now it's very good as a theory to understand this, right? But from this theory, right, one immediate observation that you can make, one immediate observation of a challenge that you can make out when these variables would be integrated into a PD model. So we have talked about scorecards, right? We have talked about scorecards. We have talked about identifying how to identify the probability of a borrower being a good borrower or a bad borrower. We have talked about that, right? Now we are talking about this. So can you find out a gap, right? And one challenge which we can actually face the moment we try to integrate these two models together to get a next 12 months point in time forward looking macroeconomic adjusted model. So what do you think would be the immediate challenge that we'll get to face? Then we'll come down gradually to the checklists and the questions that we need to answer before we start developing the next 12 months PD model. So we'll come down to that. But before that, what do you think would be the immediate challenge? I put myself on mute and I'll take up the answers from your end. Yes, guys. So is the question clear? So what do you think would be the challenge the moment we try to put in these three variables or these macroeconomic variables into the point in time PD model and thereby try to make it a forward looking model? So what are the basic challenges? Yes, one by one. You can unmute yourself and take it up. I open the discussion to
Yeah, so Tanmay, I have a question here. So this ISLM model is basically the pure macroeconomics model which we learned in macroeconomics.
right, right.
Okay, okay. So, but the only factor which we'll be using from this model would be the interest rate, the fluctuation in the interest
The
rate, and
interest
how is it
rate,
impacting us.
output, and obviously if you're using the interest rate and the output, what you are also doing is you are bringing in the price level at some extent. Because from here we can extend and show that if the rate of interest is going up and the output is increasing, it implies that the aggregate demand is
Yeah.
increasing, which implies the price level is also increasing. So that's an offshoot of it, right? But this is the pure ISLM
So,
model that we learned in our macroeconomics days.
okay, okay. So the other thing is that when we talk of output and when we talk of pricing, so what kind of output are we talking?
The
Is it
output is purely the
productivity?
GDP over here. The output is purely GDP over here.
So are they not directly correlated to each other? And since these two variables are correlated, we either have to choose one of them due to multicollinearity.
Yes, absolutely, they are correlated with each other, and that's one of the biggest challenges. That's one of the biggest challenges, which is rightly pointed out. So the first
Yeah.
problem is that of correlation.
So later down the line, we'll be checking that multicollinearity
Now the
we'll be
question
using
is,
either of them.
yeah,
Is this
I'll come to that
okay?
question. Now the question, the point that Anshul has raised over here is itself a very nice point that it's a correlation. There exists a huge correlation between these two, right? Or between these three variables, right? Now the question that comes out over here is that if there is a correlation, right, it will lead to an association between these variables. So how to solve it? So what is the solution? And also he mentioned a given point that we have to use either one of the variables. Now the question is that if these are the three variables, which is the one that I choose? Right. So out of these three, which is the one that I would choose? Because like in regression, when we talk about multicollinearity, what we do is we use a very simple VIF concept and I solve that problem. But if this is a time series data. Over here, VIF is not an applied, VIF is not applicable, right? So if I want to solve this problem, I have to solve this in some other ways. So I need to take into account the correlation between the variables. That's perfectly an important point. But this is not the most basic challenge that I would face. What is the other basic challenges? What other challenges can I face? So I'll take that point into consideration, Anshul. Yes, the others. The first and the most basic challenge that you will face when you are trying to make a model or a forward-looking point in time next 12 months BD model is that you are trying to punch in two set of variables together. One set of variable obviously is your time series model variables, which are your macroeconomic variables. The second set of variables is a set of cross-section variables, which are your account level variables or your variables in the behavior scorecard. So the question is, the biggest challenge in building the next 12 months point in time PIT model is to integrate these two types of variables in one common modeling framework. Now, when you are doing that, the question that comes out is that if I'm incorporating a macroeconomic variable into the PD model or trying to assess which is the mod, which is that variable that I need to use, there I need to understand which is that appropriate lag that I need to put for the macroeconomic variable. Which lag of macroeconomic variable would be explaining the default rates the best. So over here, the problem is not only a single problem. Correlation is only one of the problems, right? So so another important problem that I have over here is that of your optimal lags. So what is that optimal lag that I need to use for a given macroeconomic variable? What is that optimal lag? Right? So the lag selection is also a very important point. Now, there is another so a very big challenge, of developing this model is that when you are trying to develop the logistic regression model and you develop your behavior BD model, you tried developing it such that there is no autocorrelation. But autocorrelation is the essence, or a serial correlation is the essence for the macroeconomic variables. Because if a macroeconomic variables, the lags are not correlated serially, then it is not possible for us to develop the model or develop a time series model as such, right? So this is a very basic difference. So this becomes as a very important difference between these behavioral variables and these macroeconomic variables. So these are the three. So this is another important challenge that the macroeconomic the macroeconomic variable adjusted point in time next 12 month PD faces, right? So developing the PD model in IFRS9 framework is more challenging than developing a PD model under a behavior scorecard or developing the same PD model under Basel models, because over there you are not bringing in the role of macroeconomic variables. Over here you need to do that, right? So there's a problem as well as optimal lag, as well as there would be a problem associated with autocorrelation. The next problem that we have over here is with autocorrelation, or we have it with serial correlation. Autocorrelation or with serial correlation, right? So the next stage that we need to understand is two set of modeling approaches. Number one, first is a cross-section modeling approach, kind of the model approach that we can use, and the second that we need to move into is the time series modeling approach over here. So when you talk about the IFRS9 PD model development, right, this is where it comes into. So this is the beauty of IFRS9 model development, right? The IFRS9 does not talk about any specific approach to be used, but you can, once you develop a PD model using logistic regression models, logistic regression framework, the next thing that you need to do is you need to use that same model for to adjust it on the using macroeconomic variables and then put it together to find out your final PD, right? IFRS9 talks about a marginal PD that needs to be calculated every month, right? So in IFRS9 and in Basel, what it is, we compute the cumulative PD, the PD next 12 months. Over here, we need to find out a way again to distribute that PD over a period of time. So basically, the challenge is that in the next 12 months, the overall probability of default is 2%. On a monthly basis, what is the average probability of default? So that's where you need to distribute that PD over the next 12 months, right? So the challenges in the next 12 month point in time PD model development, number one is develop the behavioral model, which is pretty well known to us. The second is, so we'll be covering that under the the scorecard development exercise. The second that we'll have over here is we'll talk about the correlation side of things. So we talk about incorporating the macroeconomic variables. The next thing that we'll talk about over here is that how to pull them together into one single model, be it using time series modeling or kind of be it using your linear regression approach. The next thing that we'll talk about over here is how is it that we can develop this model. So once we develop this model, how we can distribute the PDs over a period of time, right? The next question over here comes around lifetime PD, where we need to incorporate the survival probabilities. Because if I'm trying to estimate the probability at each point of time, right, I need to take into account the number of accounts which are attracting at each point of time and the new number of accounts which have been booked at each number of time. And from there, we need to find out the survival of each of these accounts, right? So this is precisely what. So these are the areas where we need to talk about when we talk about IFRS9 PD model, the next 12 months PD model development, right? So we have created that basic framework now, right? Now over here there would be multiple factors. There would be stock market indexes which we will look into. There would be unemployment factors which we will look into. So I'll talk about a few more macroeconomic variables and then we'll move on to discuss how this point in time, next 12 months point in time PD can be constructed and how this lifetime PD model can be constructed. The overall framework is something that we'll first talk about, right? So let's take a pause here for the day, right? Let's uh, take a pause. Next class, we'll talk about this entire PD model framework, right? From step one, so we'll start with the SPPI, and then we just refresh those steps, and then we'll talk about this entire PD modeling framework over here. Right? So once that framework is developed, then we'll move into the data to start working with that. We'll develop a behavioral scorecard. We'll bring in the macroeconomic variables. From there, we'll try to develop the models, and we'll go forward, right?
Yeah, Tanmay, so I have one question here before we close the session for today.
Uh-huh, uh-huh.
So when we talk of macroeconomic variables, we talked about GDP, GNP, and this interest rate, the output
Right.
and but
Uh-huh.
in the reality, in practicality, how many macroeconomic variables will we
See,
calculate
basically,
them?
you have multi. See, basically, now this is a very, it's a very shady area. You don't have, or you cannot
Okay.
just have a set of predefined macroeconomic variables. So there are macroeconomic variables. You have to try multiple transformations. You have to try multiple changes, multiple functions of those, and from there you need to use a variable selection approach, and you need to reach out to the final variables and see which are the variables which impact the behavior most significantly.
Yeah, yeah, but how many variables do we start with uh, before selection, before transformation? So initially, how many variables do we start with? Range it.
See, it's very difficult to say it like that, right? So I mean, I can tell you that there are models where I'm working now, right? So where we start off with nearly say 100 macroeconomic variables, and from there So where we start off from 100 macroeconomic variables and then we streamline to say 5 macroeconomic variables and do some kind 5 10 transformations of them. And then from those transformations we select it out. So we need to look into, even macroeconomic variables are related with each other. Some order of transformation may be independent of each other. So it's a very iterative process which we need to take up.
The initial selection of macroeconomical variables remains same as we do for behavior scoring, and then we follow the same process
No,
of
so you cannot use it. No, 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 no,
selecting
no. For macroeconomic
the
variables, like say you have you do an optimal lag analysis, then you identify okay which are the variables which have long-term association. Then you find out the causality that which is the variable say x causes y but y does not cause x significantly. Then if x causes y and y does not cause x, then you choose x because you know that if x is there, y is automatically explained or the impacts of y are automatically captured. So there is this we use range of causality, angel range of causality, and we find out that which is affecting what, right? And from there, the variable which affects x, but where x affects y, but y does not affect x, we reach out to those models iteratively. So there are a lot of variable treatment approaches that we need to talk about. There are long-term association models. We talk about co-integrations, where we talk about causality approaches. We talk about the integration of causality, and from there we try to identify that which is a more robust variable to use, right? Hello, Anshu, is it clear? Okay, so this is the way, and okay, so I'll share over the recordings, right? I'll get this recording converted, rename the other recordings, I'll share it over, and I'll also provide the download link for you guys. Thank you. I'll do that. So thank you guys. Thank you for your time, and let's catch up next week. And okay, next week for Saturday, I'll have an extended credit risk modeling session. Okay, so we'll have 2 classes next week because we missed out the sessions this week, and yesterday's session was not very comprehensive because of internet issues. So we will try to work around that the next week, right? So thank you guys.
yeah,
Thank you for
right.
your time. Okay, so let's catch up next week, and thank you.
Yeah, so Tanmay, the
Uh-huh.
another thing is that we do not have the recordings of previous three sessions.
Yeah, so
So it would be
I'll
very
share out
good.
everything. I'll share out everything. I know that. I know that. I'll prepare that and
Yeah. So
I'll give the right locations to you guys.
thank you so much.
Right. So
Thank
I've
you so
been
much
caught
for
up
your
on
time.
multiple fronts. Yeah,
Yeah,
yeah, yeah,
yeah.
yeah, yeah. So I've been caught up on multiple fronts and since I could not make out time to do this thing, I just sit down and do it today and share. Thank you
Okay.
guys. Thank you.
Thank you.
Uh,